So here we are, class 12, into the month of October. What we want to do today is talk the legal structures of investing and then get a little bit more in detail about active versus passive investing. There's definitely much more research you could do on your own, but we'll hit it, including a couple of active strategies that you can employ. And then expenses and investing, an important topic as well. We mentioned that in previous class about how you need to really watch the management fees you're paying, the expenses you have in investing, because that can really make your portfolio perform much worse. And then measuring return. We won't get into measuring risk, but we'll start on the section about return and risk, and we'll work on return today. So back on the class notes, page 28, we'd finished talking about the 1933 Act. If you were going to buy your own securities, you were protected by the SEC Act of 1933. Well, now we'll go move 7 years later to SEC Act of 1940, and here they're protecting people investing in investment firms. What kind of information, what kind of regulations should those firms follow? So the most popular of these are mutual funds. A mutual fund, there's an investment company, and they create a trust, and they commingle the assets of several investors together. So if you can go in, and the nice thing about this is you as the investor do not need a whole lot of money, because if you walk into, say, a BlackRock or a Vanguard, these are firms that have trillions of dollars in investments, and Fidelity and T. Rowe Price and many others. You only need a couple of $1,000s, and they have a fund that might have hundreds of billions of dollars in it. You can walk in, give them your money, and suddenly you're very well diversified because you're one investor out of many. So the investment companies and the trusts, they don't all have to be owned by the same people. So a good example is UTSA. UTSA sent its investment business to Victory Capital, but those mutual funds are still UTSA mutual funds. It's just that UTSA's mutual fund board hired Victory Capital. So UTSA's mutual fund board, the board over the mutual funds, which is a separate entity from UTSA, that board said, hey, we have these UTSA funds. Right now they're being managed by UTSA. We want to shift management and move that management over to Victory Capital. And so UTSA sent its employees, most of them, not all of them, over the Victory Capital. And so Victory Capital is managing UTSA's mutual funds for them. That's what the UTSA Mutual Fund Board does. That's a board I used to have to report to every quarter on our performance. So they decided, it was UTSA decided they did not want to do this anymore, and they convinced the UTSA Mutual Fund Board to change who the manager of their funds would be. So it doesn't all have to be, it's usually the same firm. Fidelity mutual funds are managed by Fidelity employees, but it's possible Fidelity Mutual Fund Board could say, we don't like Fidelity anymore. We want our funds managed by Vanguard or BlackRock. I doubt that's ever happened, but it's certainly possible. When you buy a mutual fund, you're buying at the NAV, which is the net asset value, and you're receiving fractional shares. That's another nice thing about mutual funds is if the mutual fund is trading, say, for $97, and you want to invest $10,000, so you take $10,000 divided by $97, you don't get an even number. It doesn't matter with mutual funds. You can invest $10,000 and they'll give you exactly $10,000 and you'll get fractional shares. You can't buy fractional shares of Apple stock or of Exxon stock, or obviously Tesla and some of these firms, Google, whose stock prices are getting up there. If the stock price is $500 and you only have $400 to invest, you can't even buy one share. But with a mutual fund, yeah, if the mutual fund's for some reason trading for $500 per share, you can buy $400 and get a 0.8 share or whatever it would be. So you can buy fractional shares. I had to do this early in my career at UTSA. The lady who did this for UTSA's insurance funds, she had to go out on maternity leave, and she asked for a volunteer to do her daily pricing. So I volunteered, and it was very interesting. I had to come up with the share price at the end of the day, and I would have to go out sometimes 10, 12, 13 basis points, decimal places, in order to get the price to match so that the assets minus liabilities equal the fund's net asset value. You strike the NAV every day, but at the end of the day. And so one thing with mutual funds is you can only buy mutual funds at the end of the day price. So if you invest at 9 a.m. and right after you invest, the stock market shoots up 5%, well, you're not going to get that 5%. You're going to get the close of day price. So you can send them your money at 9 a.m. in the morning, but if the stock market shoots up 5%, you're going to have to pay that 5% higher market value at the end of the day, because they will not give you your NAV until after the market closes on that day. So you only get one price a day, and that's all you can trade at. Some people find that very frustrating. If you're a day trader, you definitely would not use mutual funds because you can only trade once a day right at close. But when you do trade, you get that NAV. Now, the NAV is extremely important. I remember there was one day someone had typed the wrong S&P 500 value, and they discovered it later in the day, and every mutual fund out there had to bring all their employees back in, all their accountants back in, and they had to restrike those NAVs, because if they didn't do that, they would have given the investors of that day the wrong number of shares, and the people selling that day would have gotten the wrong number of shares, and they would have had a mess on their hands. So they had to come back in and reprice that. In some of the mutual funds I ran, there was one in particular, I would check them at the end of the day, and I could just tell its price did not look right. It was probably 4 or 5 o'clock in the afternoon. Maybe it's probably 5 o'clock. That's when they struck the prices. So people were heading home. So I called the accountants and I say, there's no way that NAV is correct. And they looked at it, and sure enough, they discovered it did not make sense the way they priced it. And they weren't too happy with me. They all had to come back in, but in a way they were happy, because if they had not caught it, it would have caused a major problem the next day. They would have been working a lot more overtime. So, so these NAVs can have errors in them. People do type the wrong number sometimes, or send the wrong number, and that can cause a huge, huge problem. The advantage of mutual funds is that small investors can get diversification with very little invested. So a lot of mutual fund companies, if you set up a Roth IRA, they'll usually say, if you have a Roth IRA, we'll let you invest as little as $50 a month. As long as you do $50 every month, they'll let you do that. If you don't have it in Roth IRA, their minimums might be $2,000 or $3,000. So, you know, there are minimums, but they tend to be set up for small investors. So it is a good way to invest. Markets close at 4 o'clock. Eastern Standard Time, so you have to get your money in by 4 o'clock. Otherwise, they'll invest it the next day. But it allows small investors to hire very well-trained portfolio managers without having millions of dollars. The second type of account is what's called a commingled account. A commingled account is very much like a mutual fund, except it doesn't have tickers. It doesn't trade like a stock like mutual funds. It doesn't have a ticker where you can go and look it up. It's between large institutional investors. They directly invest with other investors, but instead of investing $2,000, they're investing maybe $50 million or $100 million. And that's a commingled account. It's a lot of large investors. They get daily pricing, just like with the mutual fund. Everything looks the same. It's just that it's not traded on the stock market. It's just between investors. So if you want your money out, it might take a little bit longer. There's contracts. So it's really intended for large investors. I think the smallest commingled fund I've ever been involved with is maybe investing, I don't know, $50 million or something along those lines. Maybe some hedge funds. We had a hedge fund set up just for us that may have only been $5 or $10 million, but you tend to have several $1 million to be eligible for a commingled account. The fees are usually lower, and you're protected from a bunch of small investors all getting out at once because of a market crisis. You have some protection from that type of bad behavior. What's really popular today are exchange traded funds. So essentially they're mutual funds, but they trade just like stocks. So you can trade, the biggest thing is you can do intraday trades. So if you want to buy an ETF at 9 a.m. or 10 a.m., I'm talking San Antonio time, because the market's open at 9:30 Eastern time. But if you want to trade 10 a.m., you can do that. And whatever the market is at that point, that's the price you're going to get. And it's a price just like any stock, so you get whatever price is shown there. And that it's possible that the price you see that you get may not match the underlying assets. So these do trade at what we call discounts and premiums. They're pretty small because hedge fund managers could come in and take advantage of that. But it's possible the underlying assets are worth $90 per share, but the ETF trades for $90.20. So you have to watch out for that type of thing. But essentially they'll trade very much in line with the underlying assets. And I used to doubt this, that they were better from a tax standpoint, but I read a really good article on that, and I can't replicate everything they said, but I'm convinced that you do have some advantages tax-wise with an exchange-traded fund versus a mutual fund. I don't think it's huge, but I do think it's bigger than what I thought it was. A lot of people are moving to exchange-traded funds. I want to show you some examples of that. So what I want to show you is some of the largest players. So iShares, extremely large firm. I like their products. I use their products quite a bit. Very, very large balances. So you can see very much what we did on exam 1 and talking about the different asset classes. That's what they have. So look, they have equity, fixed income, commodity, and when they say real estate, that real estate is probably real estate investment trust. We talked about that. They also have core products, factor products, trend products. They even have societal type of products. So if we click on equity, we'll see what kind of equity funds they have. And here you'll see, again, very similar to exam 1, they're going to show us the large cap. So right here, IVV is their big one, the iShares. This is the S&P 500. Look at the expense ratio. Look at that. That's 3 basis points. 3 basis points. That's even cheaper than what we saw in the Vanguard Mutual Fund. Very, very inexpensive. That's one of the huge advantages of these things. They're extremely inefficient. If you go down, you'll have a few others. They have MSCI. That's an international developed market. They have a mid cap. We talked about that. Small cap. There's the value. Remember we talked about growth versus value. There's a growth fund. There's a growth fund, S&P 500 growth. Emerging markets, we talked about that, mid cap. They have a few other specialized ones, some factor funds. Factor funds have gotten really, really popular. There's a momentum fund in there. So they're doing some special stuff. So if you look under fixed income, let's see if we recognize anything from our class there. And here they have is the aggregate bond index, which is just all bonds. Again, a very, very low expense ratio, only 4 basis points. They have a TIP fund. Remember, we talked about TIPs. They have a mortgage-backed security fund. Then they have a short-term treasury fund. They have an intermediate-term treasury fund, a long-term treasury. They have a municipal bond fund. Remember, we talked about municipal bonds. So all the stuff we talked about, that's what they're offering. So you can see I did not make this stuff up. This is, exactly what these firms do. They have an international bond fund. Remember, for our case, we put that under alternatives and not under bonds because the U.S. versus U.S., you're really getting exposed to currencies. But they only charge 9 basis points. That's pretty amazing for an international bond fund to charge so little. And you can see there's many more to go. I'm only on page 1. So they get very, very specialized. On the commodity side, they have a gold fund, a silver fund. They have the GSCI commodity. We talked about that one in class. So they have a few others that are specialized, another gold fund, but they don't have as many of these as they have other things. And then you get the real estate. Probably don't have too many of these, but they have a real estate, which is a real REIT. They have a specialized one, just particular fund managers. They have a mortgage REIT fund. They even have a residential real estate ETF. That's an interesting one. They have an international REIT. So interesting. Everything we talked about in class on bonds, its duration, its convexity with mortgage-backed securities, its credit. I didn't show you the credit, but they would definitely have had a high-yield bond fund and a high-quality bond fund. They had municipals. They had inflation-protected bonds. We go to the next one. This is State Street, and they're not letting me in here. They won't let me in here without, I'll say I'm an individual and accept, without clicking all the buttons. But they have ETFs probably very, very similar to the iShares. The iShares used to be Barclays Bank, and they've moved over to BlackRock. State Street does the spiders. You may have heard of spiders. So you do the ETF finder, and you'll see very similar to what we saw with BlackRock. They have it by asset class, and you can see the asset classes. They have an alternatives. They even have infrastructure. We did not talk about infrastructure and alternatives, but that's a pretty popular one. That's building like toll roads and those type of infrastructure type of projects, bridges, those kind of things where the city allows you to collect revenue as part of the construction. Equity, they have it mixed sectors or sector funds. They have it by style, core, growth, and value. We talked about those. Fixed income, they have the aggregate. Convertible, we talked a little bit about convertible, not much. They do have a credit, inflation, municipal, securitized. We talked about structured debt. So, they have a lot of the stuff we talked about in our class. Vanguard's also in the ETFs. Theirs are called Vipers. So you have spiders and vipers. Very, very, very similar. In fact, Vanguard did something really smart is they did not set up whole new portfolios to do the exchange-traded funds. They just made their exchange-traded funds shares in their existing mutual funds. So they didn't have to add anything new, and they already had trillions of dollars set up, so they just, it was a really smart way of doing it. But so again, it's going to be growth and value, large cap, mid cap, just like we talked about. And then you can get really specialized. So ProShares, they do some stuff that is, really, really pretty amazing. Now I have the general stuff we saw with everybody else, fixed income, alternatives, but what they have are these geared funds. So let's look at geared broad market equity, and let's do inverse first. So with the leveraged, with the levered, what they do with the levered is, let's take the levered, not the Dow, let's do the levered. So here you can see it's a 3-time fund. What that means is if mid-cap stocks, this is a mid-cap, if they're up 1%, this fund will be up 3%. It is struck to move 3 times more than the underlying security. Yeah, so these levered ones are really, really, really interesting. Let me find an S&P 500 levered one. Here you get S&P 500 levered. It is 2 times. So if the S&P is up 1%, we'll be up 2%. If it's S&P's down 10% or 11%, we've had some big days this year, then this fund could be down 22%. You could lose a lot of money. I don't know what happens to this fund if the S&P falls 50%, because you can't lose more than 100%. So it's, it's levered, and eventually at some point, if a major market sell-off, it could just completely go out of business. So there's the S&P 500. They'll have a fact sheet that they'll explain everything that they do. And you read that very, very carefully. So the ticker is SSO. So let's try putting SSO into our ticker. And what we want to do is see if we can compare this to the S&P 500. So here's the SSO, and you can see they're already comparing it to the SPY because I set up that before. That's the S&P. So if you look at it, it's 2 times, and boy, you can see the sell-off this year. Boy, it sold off a bunch, but it's actually recovered more. So it's much, much more volatile. If you remember your capital asset pricing model with the beta, essentially this fund has a beta of 2. If you were to calculate its beta, it would be 2. So how close did they get? The S&P is up 76%, and they're up 152%. So pretty amazing, amazing stuff. That's the ProShares levered. They also have a ProShare inverted. So if you look at that, let's do the broad market, and let's do inverse. And here, let's see if we can find the S&P 500. There it is. So this is a -1 time the S&P 500. So here, if the S&P 500 is down 5%, this fund will be up 10%. Well, obviously, that's going to look very, very different. So let's try SH. I don't know if I can add SH in here, but let's see. We'll try an SH Pro Shares. Well, you can see it's just going down. So if you really think the market's going down, you could do this fund, and it will give you negative 76% when the market's up 76%. You would not have want to been in this fund the last several years, but you would have want to been there earlier this year, back in March, when the S&P was falling. This fund went up dramatically. So really interesting funds. So that's ProShares. ProShares has these double funds. They have these inverse funds. They have some where, you know, interest rates rise, bond prices fall. So they created these inverse bond funds so that if interest rates rise, they actually go up in price. They have what we call negative duration. And then you have Direction. They have some really interesting ones, some levered, some strategic weighted ones, relative weights. So if you're interested in some really cool exchange traded funds, you may look at them. You've got to be careful. Some of these funds, we haven't talked about the VIX yet, but the volatility index, it measures the volatility price in the option market for the S&P 500. They actually trade on the VIX. Some of these funds just don't do what you expect. The VIX might be up 20%, but the VIX fund might only be up 10%. So they don't always do what you expect. So I highly recommend, if you try one of these funds, do what I just did. Graph them against what they're supposed to produce. If you're trying to find a VIX fund, then graph it against the VIX. So yeah, look at that. They have a 3 times fund, 3 times fund. So you know, be careful. Always model these out. It looked like the ProShares was working exactly like you would expect them to have worked. They did extremely well, very much in line with what you would expect. So this fund should have a -1 beta. I think what gets really crazy, and it's almost mind-boggling, is you can buy options on these ETFs. And we'll talk about options later, but I asked some of my finance students, what does it mean to buy a put option on the SH? A put option is what you buy when you think the market's going to fall. But if you buy a put option on SH, is that the exact same thing as buying a call option on the S&P 500? So yeah, I mean, and will the option price on the SSO be twice as much as the option price in S&P 500, or close to it, just because it's got twice as much volatility? We'll talk more about that when we talk about options later. So those are exchange traded funds. The world is getting crazy on those. Most exchange traded funds used to be passive. They were index funds, but today they're doing active, doing all kinds of things. UTSA set up some exchange traded funds doing what's called smart beta. The guy who set all of it up, he's still at Victory Capital. I've been trying to get him to come talk to the Investment Society. I might be able to get him to do that this semester. So really exciting thing. Smart beta is something you could Google and look up. I would look up smart beta in relation to a guy named Robert Arnott, A-R-N-O-T-T. So just try smart beta and Robert Arnott. And if you want to get the debate on the other side of it, you might do smart beta and Cliff Asness, A-S-N-E-S-S. Really some great articles that would give you some great insight. What do we mean by smart beta? Robert Arnott's one of my favorite writers and favorite speakers of all time. Really, really excellent. The next one is what most of you will have, is a 401k plan. So essentially these are commingled accounts. Sometimes they're actual mutual funds. And so and it's the same way with mutual funds. You get end of day pricing. You can't invest during the day. So your employer will set up a 401k plan, and they'll give you a choice of large cap stocks, small cap stocks, growth value. When I took over USA's 401k plan, we had 3 options: a bond option, a stock option, and then what they call a fixed option, which is like a certificate of deposit option. and I took it from 3 to 13, and I think they've added a few more after I left. But we added a growth fund, a value fund, large cap, small cap, international. So we added all those things we talked about earlier in the semester. One thing you have to be really careful of 401k plans is employers that do what's called bundling. I do not like bundling. We had a gentleman, well, actually twice at USAA, the bundling came up. And we looked into it from our department. And you have to remember, when you run a 401k plan, you are a fiduciary. So I was legally bound to only act in the best interest of the employees that were invested in the 401k plan. I could not act in the best interest of USAA. I had to, what I was doing, put the employee first. They were the beneficiaries of the plan, and I was a fiduciary. And bundling, to me, there's no way I could argue that bundling was in the employee's best interest. But essentially what bundlers do is, you have a fund. USA had, I don't know, $3 billion, excuse me, $3 or $4 billion in their 401k plan. And they got really good pricing because we're investing $400-500 million in certain funds, so we could get really, really low pricing. And what the Human Resources Department wanted to do was say, let's shift this, and we'll give the business to Fidelity, and Fidelity will give us record keeping for free. So USA was paying $500,000 a year for record keeping, and the Human Resources people, that went through their budgets and say, well, we want that for free, so we'll just shift all this to Fidelity. Well, Fidelity's really happy. They're going to get $3 billion in assets, and they're going to overcharge in their fees. So instead of charging 20 basis points, they'll charge 50 basis points. And so what happens is USAA takes that $500,000 they were paying in record keeping, and they instead increase the fees, the management fees that their employees are paying to Fidelity. Fidelity's happy. They lose $500 million in record keeping. They may pick up over $1 million in management fees. USAA is happy because they've saved $500,000 in record keeping expenses. It's the employees who get shafted, but USA's argument was they won't notice that. And their main argument they made is, well, just give them more choice. Well, I hated that discussion because one of the funds that we had already been given our employees was in the exact same category they were wanting to shift to, just at a higher fee. And how can I say it's better for the employees to have manager A at 20 basis points and we shift them to manager A at 40 basis points and say that somehow that employee is better off? So I do not like bundling. I think it should be illegal, or at least should be disclosed, and you have to check on it because the employer will hide it. And I don't think most employees that do bundling actually know it's a ripoff of their employees. I don't think they've actually noticed it. So I fought it once. I actually was going to follow my sword, and fortunately I didn't have to. The committee decided not to do it without me having to say anything, but the Human Resources people were really mad at me for fighting it. Got so mad at me that the head of the Human Resources said, we'll shut Ron up, we'll take it to the committee, have them approve it, then he can't do anything. And they took it to the committee, and the committee was absolutely against it. And then about a year later or 2 years later, a gentleman came from Dial Corporation, and he wanted to do bundling, and we went through the same thing again. And he said we were stupid for not doing it, and then we showed him all the math, and he realized that he had been ripping off his employees at Dial. So it's an interesting debate. If any of y'all get a 401 plan and you want to figure out if there's some unethical behavior going on, you're more than welcome to call me and talk about it. We could probably figure it out together. All right, let's talk about active versus passive investing. For active investing, you're trying to find managers who are going to beat the market. So if the S&P 500 index is up, say 4.2%, then you need to make 4.2% after fees. And however much you beat the S&P by, or how much you lose to the S&P, that's called your alpha, A-L-P-H-A. That's an important term. We'll talk about one thing you could go out and actually research that'd be really interesting is alpha beta separation. You should Google that and read articles on that. It's very, very, very interesting. But we use the word alpha and beta in a nuanced way versus what you're used to with the capital asset pricing model. So alpha is how much you outperform the market, and beta is the market itself. So that's another way of thinking about beta. It's a little different what we'll study when we talk about beta later in the class. So beta is taken somewhat of a life of its taken up a life of its own. So alpha is how much your return differs from the market. It can be a negative number. So if the market's up 4.2% and you're up 3.9%, your alpha is negative 0.7%. You underperform the market by 0.7%. So you're trying to find managers with good processes. We talked about this earlier. Good processes that can consistently outperform the market. There are very few of those. It's very, very difficult to do. Performance is extremely inconsistent. It's very difficult to tell the difference between skill and luck. I had a boss once that said, you know, Ron, we're trying to find these top tier managers, but we don't have to be that great. Just find me managers that are consistently in, say, the top 25%. I'd be happy with that. So I went out and looked at thousands of funds. And sure enough, I found 11 managers who were consistently in the top 25%. So I'll go tell my boss, okay, I found 11 managers who have consistently been in the top 25%. But by the way, boss, I calculated this. If this has just been randomness, if there was no skill as pure randomness, there should have been 13 managers that were consistently top 25%. Instead, I only found 11. So there's a good chance those 11 managers that have been consistently in the top 25%, they were only there because of pure random chance, not because of skill. It is very, very difficult. If you take my risk management class, we actually calculate some of these ratios to try to figure out if a manager is performing well or poorly. And it's a very interesting exercise to do. And if you don't want to take that class, but you want to learn how to do that, it's called manager attribution. Email me and I'll send you the files and you can do it yourself watching the videos. So that's active. You're trying to beat the market. It costs more to do that. So, so the fees will be higher, but if you're really good, you can beat the market plus cover your fees and you'll have a positive alpha. Passive is when you just buy the market. So your fees are extremely low. You buy an index mutual fund, an index commingled account, an index ETF. And it usually reflects the belief that markets are efficient. So we're supposed to talk about this efficient market hypothesis. What does it mean that markets are efficient? That trying to beat the market is usually going to be a loser's game. And what we mean it in two ways. Markets can be informationally efficient. That is, that new information gets in the stock prices almost instantaneously. There have been some studies that challenge that, especially earnings releases. There have been studies that show that earnings releases actually take a few months to fully be incorporated in stock prices. I'm not sure if that's still true today because hedge funds have been going after those anomalies. And then there's fundamental efficiency, and what that means, all securities are correctly priced at all times, are really what it means. If there are errors, they're uncorrelated, they're just as likely to be overpriced as underpriced. There's no such thing as market bubbles. The markets are fundamentally efficient. I have a debate of that, but we won't do it in this class. But if you take my security analysis class, we'll definitely talk about it in there. So there are definitely some issues with that. So let's talk about this efficient market hypothesis. Eugene Fama, famous gentleman in finance, I think he's a Nobel Prize winner, but he came up with this efficient market hypothesis way back in the 70s. He's still alive. He's still highly respected. You can actually go to YouTube and find interviews with Eugene Fama. I just listened to one not too long ago. He's still a very spry and very outspoken man, although he's getting up there in age. But he did, and back in the 70s, he did 3 tests to see how efficient markets are. He did a weak form test, a semi-strong form test, and a strong form test. So the weak form test is he wanted to see if just using stock prices and volumes, market data, you didn't look at the fundamentals, you didn't look at the financial statements of the firm at all, you just looked at past prices, could you beat the market? There he's talking about technical analysis. And his conclusion was no, it doesn't work. And one thing he did I thought was pretty eye-opening is he went to technical analysts and he gave them actual stock charts, and then he gave them some charts that they created using just random numbers. And he asked the security analysts which of these are real stock charts and which of them aren't, and the analysts could not tell the difference. So if the analysts are really seeing something that's not just random noise, why can't they tell the difference between an actual stock chart and randomness? Now, there is a big debate on this. If you want to get in this debate, the best person to go to is a gentleman named Andrew Lo. Andrew Lo wrote a book on technical analysis, and I'd recommend reading his book. He doesn't tell you how to do it. He doesn't give you strategies for how to do it. He essentially lays out the theoretical argument for why technical analysis should work. So if you want to do technical analysis, you need to have a theoretical basis for it. Dr. Andrew Lo does that. There's another book on technical analysis written by Dahlquist, D-A-H-L-Q-U-I-S-T, a former professor from UTSA. Her book it's a long book. She goes through all these strategies, but that might be a book you might want to purchase. I would start with Dr. Lo first and see if you can buy into the argument that technical analysis works. But Dr. Fama, he said it doesn't work based on his studies. The second analysis he did was a semi-strong test. And he asked, can you use using all public information? That includes prior stock prices, but it also includes balance sheets, income statements, news on sales, anything you can get about the company, what the CEO says. Can you beat the market? And he found, somehow, it's a hard thing to test, but he found that no, you cannot beat the market with public information. Now, there's been other studies that have disagreed with that. You look at some of the like Renaissance hedge funds that have just incredibly outperforming histories. There are certainly people out there that are beating the markets quite consistently, and they seem to have some secret weapon to do it. That it's hard to explain it just by random chance. However, at the big picture, if you just look at mutual funds and commingled accounts and ETFs, boy, it's hard to find much evidence that managers can consistently beat the market, except for the few just incredible winners out there. But this is referred to as fundamental analysis. Looking at all the data. If you take my security analysis class, we do quite a bit of fundamental analysis. And his conclusion was, no, markets are very efficient. You can't beat the market. Why? Because markets are so informationally efficient. As soon as public information hits, the market price immediately reacts, and you can't trade fast enough to get in there. Only the very fastest traders can get in, and those are those hedge funds that are sitting right next to the exchanges, so they can win by speed of light seconds, fractions of seconds. The last test he did is called the strong form test. And this, he said, all information, including non-public information. And this is a very, very difficult one to test, and he was pretty inconclusive on this because using non-public information is illegal. And so where do you even get the data to test that? And so, yeah, he had a hard thing to test. What he tried testing was looking at the trades of insiders like CFOs or CEOs and watching when they did an unusual trade. So maybe a CEO normally sells 50,000 shares every year at about the same time just to fund, vacation or something like that. But then one year she does 500,000 shares. It's an unusual trade. What Fama would do would look and see if those trades actually did better than the market. And it was inconclusive still. It's hard, really, really hard to tell. Now this brings up the question, when is using non-public information illegal? So let's say you're on the plane flying somewhere and the CFO of Valero is sitting behind you and he or she says, well, you can't believe what we're about to announce tomorrow. This is really going to hit the markets. And you hear it, you get all the information, you know their stock price is probably going to go up 5 or 10% tomorrow. Can you go home and buy Valero stock before it opens up, that news hits the market tomorrow? And the answer is no, you will go to jail. And in fact, when a firm announces really big information like that, the first thing the SEC is going to do is go out and find people who did unusually large trades right before the information hit. And they'll look and say, wow, this person bought 100,000 shares and they bought all these call options. They've never done a trade like that before in their life. And oh, look, they were sitting on the same plane with the CFO of Valero. Wow, that's interesting. So what do you do if you get non-public information? And what we were told to do is the first thing you do is you talk to your lawyer. And your lawyer would then probably call the firm and say, you have non-public information that has now been released. You need to immediately release this information to the public. Don't wait a day or 2 or 3. You need to tell the public this information because it's going out there. And you need to make sure, you as the investor, that you do not touch their stock. You do not want to buy their stock at all. You can actually go to jail for that. Now that's for material non-public information. You can trade non-material information. So if it's non-material but it's non-public, you can trade on that. And let's see, for some strange reason, you find 1,000 pieces of non-material, immaterial, non-public information. You can trade on that. As long as the individual pieces of information are immaterial, it doesn't matter that if in total they're material, that doesn't matter. You can still trade on that. The question is, what if it's material or not material? And that's something for a judge and a jury to decide. So I would still say, if you get non-public information, you might think it's immaterial, but I wouldn't trade on it because it's a really dangerous thing to do. So there's Fama. We're supposed to cover this in this class. You can read up on your own. I don't want to spend a whole lot of time on it. And you really should read the Bates. Actually, there's a great book by Andrew Lowe. I just mentioned him. It's called The Efficient Market the Adaptive Market Hypothesis. I do recommend you read that. He definitely challenges, Dr. Lowe definitely challenges the efficient market hypothesis. And he provides data for why he does not believe markets are truly efficient. So Dr. Lowe is a really good name to keep in your reading list. Watch his YouTube. He has a lot of YouTubes available. So what about passive investing and the social purpose of investing? I'm jumping a couple of pages ahead in your notes, but up to page 32. I just thought this was in the wrong place in the notes, but I didn't want to switch it. So the reason we have active investing is so that active investors can decide which companies are doing well and which ones are doing poorly. And they can then buy the good companies and they can sell the bad companies. The bad companies go out of business. The good companies get bigger. That's called allocative efficiency. And we need investors to do that, right? We need investors to say, hey, Blockbuster goes out of business, Netflix gets bigger, Sears, Kmart go out of business, Amazon gets bigger. We need people making those decisions. That's what capitalism is all about. It's about winners and losers based on who's the best at what they're doing. We want to reward the people that are doing well so they get larger and the consumer wins. They get better prices, better products. So as people have asked, well, if everybody's passive, then who's going to achieve this purpose of allocative efficiency? I don't think that's an issue yet. Passive investing is growing, but it's still only maybe 30–40% of the market. So there's still a lot of active managers. And what I think is interesting is a firm like BlackRock. BlackRock does a lot of passive investing, but they also do a lot of active investing. And so what they do is, when they vote the shares of the stocks that they own, their active managers vote not just their shares, they also vote the shares of the passive managers. So the active managers say, we need to replace the management of this firm. They're not doing a good job. Well, BlackRock can take the shares from their active managers and their passive managers and vote them. And that way, you're still getting the allocative efficiency, even though you have a lot of passive shares out there. I like a quote that Warren Buffett had about investing. He said, active investing can work if you have a long enough horizon. And why is that? Because he said, investing is like batting, where they never call strikes. So you can just sit there and wait for the best pitch you want, and you can sit there forever. You don't have to invest. You don't have to swing. Baseball would never work with that because people would just let the pitcher wear out. And I agree with that. That is true. I do think active investing can win if you have a 5 to 10 year horizon. Bill Gross, the famous bond investor, he said something very, very similar to that. Unfortunately, in the job I was in, I was paid not to wait for the fat pitch. I was paid to swing. There's actually built into our profession an impatience in how we invest, and so it's tough. That's why some people like family offices as a place to work. I wish I had known about family offices when I started out. That would have been a great place for me to work. family offices are when these really high net worth individuals take all their money and they create an investment pool and they're investing it just for the family, and they'll take a 3, 5, 10-year horizon. They don't care about short-term underperformance. Yeah, that would be a perfect place to work. But most of investing doesn't let you do what Warren Buffett says. You've got to do something. You've got to be investing. You've got to be moving, creating activity, whether it's adding value or not. So when we're talking about passive, you do need to know your major indices. The S&P 500, that lines up to what we talked about as U.S. large cap. It's a market-weighted index, which is really, really good. There's very little trading in the market-weighted index, because if Apple's 4% of the index and it grows to 6% of the index, you don't have to sell any Apple or buy any Apple. You just leave it. It goes from 4 to 6%. It's market-weighted. Everything's fine. The Dow Jones is a price-weighted index, which is a really bizarre thing. And there's only 30, 32 stocks, I forget, 30 stocks or so in the Dow Jones, and it's price-weighted. So if one stock's trading for $1,000 and another stock's trading for $100, then you put 10 times more in the $1,000 stock. And then the Dow has adjust for stock splits and other things. So it's a really bizarre index. I'm not sure why it's so heavily followed, other than we have a lot of history for it. The Russell 2000, the main index for small cap. The S&P 400 is the mid cap. MSCI, EFA, MS used to be Morgan Stanley Capital Indices, but it's now separate from Morgan Stanley, so it's just MSCI. They're the main ones that do developed markets, so those non-U.S. markets. EFA, Europe, Asia, and Europe, Australia, and the Far East. Emerging markets, MSCI again, they're really the international ones. MSCI does do U.S. stocks. Russell does have a large cap, Russell 1000, so there are other ones out there, but these are the biggest ones. The Barclays Aggregate is the biggest bond index. It used to be the Merrill Lynch Aggregate. No, it used to be the Lehman Aggregate, and Barclays bought Lehman when they went out of business, so now it's the Barclays Aggregate. The original indices were equal weighted, but the problem if you have equal weighted, you put 0.2% in all 500 stocks, is every time prices move, you got to rebalance, and it was just too expensive. Equal weighting has actually been a really good performer long term. I don't think it's done well this year, but long term, equal weighted has done extremely well. This year it's not doing well because it's the largest companies doing well. So if you have equal weighting, you would have been underallocated on the stocks that are doing the best this year. And now we have fundamental weighting. Robert Arnott is a big fan of that. That's another term for smart beta. So I didn't put smart beta up here, but it's known as smart beta. And we looked at these earlier, the S&P and MSCI, their methodologies for constructing all these indices. So you might read up on some of those. But definitely when you interview for a job, for an investment firm, make sure you at least know this group right here. The S&P 500, Russell 2000, S&P 400, MSCI EFA, MSCI Emerging Markets, and the Barclays Aggregate. There's also a Merrill Lynch Aggregate as well, and it's still around. So, know the major indices. Now we go overseas too. Know the UK, the German, the DAX. So know all these, the Nikkei for Japan. Know all these indices, the major ones. And the easy thing is they're listed in Yahoo Finance. So just go through Yahoo Finance and make sure you know your major indices. Now, active in managing, there's a couple of more things we can do here. One thing we can do, if you really think you know the markets, not only do you know which stocks are good, but you actually know which stocks are bad, you can short securities. That's selling something you don't own. So what do? So you actually call your broker and say, I want to sell 100 shares of IBM, but you don't own any IBM. So your broker goes out and finds another customer who owns IBM. They borrow 100 shares of their IBM, and they sell it for you. And you actually get the cash. You have to set up a margin. And then if IBM stock price falls, then at some point you buy the shares back, you give them back to the person you borrowed them from, and there's an entire industry set up for this. It's known as the securities lending industry. It's massive. Al Gore, the former vice president of the United States, was actually on the board of one of these companies. UTSA did a lot of securities lending. It added, added 5 to 10 basis points to our returns every year. So we didn't do shorting, but we did a lot of securities lending that actually supported Be careful when you short a security, because you lose money when the stock price goes up, which means, you know, if you buy a stock, the most you can lose is 100%. But if you short a stock, your potential loss is infinity. There is no maximum loss. So if you had bought Zoom, if you had shorted Zoom stock at the beginning of, during last year, you'd be in a lot of trouble right now. It works. You pay a fee to borrow the stock, and the securities lending industry makes some money, kind of a little bit of a spread. You have to set aside collateral. Your brokers may ask for more collateral if the stock price has been rising. So it's an interesting industry. I won't talk much about it in here. I do recommend, you know, set up your brokerage account and do paper money, and this would be a good place to do your paper trades, your pretend trades, so that you don't lose a lot of money. I remember at UTSA, we did what we call Y courting. You know, Y courting means I would sit and listen in on calls that our sales reps had with members. And I remember a sales rep was talking to this one lady. He mentioned to her, "Oh, you have such and such stock short. You're short 40 shares." And she says, "Oh, I forgot all about that. I nearly passed out." Is how can you short shares of stock and forget that they're short? So she probably should not have been shorting securities. When you short securities, you can do what's called a paired trade, which is something I've done before. I like it. I think it's a really good strategy. So you find two stocks in the same industry, and they usually move together, but for some reason they move apart. So maybe you're looking at Walgreens and CVS, and they normally move right together, but suddenly CVS shot up 5% and Walgreens shot down 5%. You would look at the news and say, you know what, I think the market's overreacting. So I'm going to buy Walgreens and short CVS, and when they come back together, I'll make money on that trade. And it doesn't matter if the stock prices rise or fall. You just need the stock that you shorted to rise more than the one you're long, to fall more than the one you're long on, or have the one you're long on needs to rise more than the one you're short on. If you do that, you can make money. I'll give you some examples here. If the industry falls 30%, but your stock that you own falls 20%, but the stock that you're shorted falls 40%, you made money. Yeah, you lost 20% here, but your short went down 40. Even though the industry fell 30%, you're going to be up 10%, or you're going to be up 20%. You did well. You can also lose on the other side. If the industry's up 40%, but the stock you bought's up 35, and the one you short's up 45, you're going to lose 10% there. But this brings up one of my favorite strategies. It's a hedge fund strategy called market neutral, which is nothing more than a bunch of paired trades. And so it should have a beta of 0, which means its performance should be completely unrelated to the overall performance of the stock market. So that's shorting securities. The other thing you can do is buy stocks on margin. I don't want to spend too much time on this, but essentially when you go to your broker, you want to buy $10,000 of a stock. You put up $5,000, your broker puts up $5,000, and what that will do is leverage your return. So you can get a return of 100% if the stock's up 50% if you leverage it 2 to 1. Again, be very, very careful. You do have to pay interest on the loan when you do this, so watch that. But it exaggerates, be careful, it exaggerates both gains and losses, and again, you'll have some margin calls. But here's something else that you should practice with in your ghost account, in your paper portfolio, to make sure you understand what goes on with these, understand the margin calls, understand the losses you can rack up. These can be dangerous trades. All right, so now we'll get to expenses with investing. It looks like we won't get to the return calculation yet. I do recommend on the return calculation, starting on page 32, that there's a link in the notes that links you to the Dietz method, the modified Dietz method. I'd recommend you look up that. It's in the notes. Look that up and read a little bit about it. It's down here at the bottom, modified Dietz. Before you get to the notes on that part, give yourself a chance to read something outside of the notes, and then when you read the notes, it will just give you more understanding. So, expenses with investing. If you do it yourself, you'll have certain expenses. If you hire a manager, you'll have certain expenses. So if you do it yourself, security selection, you have to hire a broker. The broker may charge commissions. I'll tell you now, the commissions I'm paying lately are pennies. And a lot of time it's zeros. So I use Charles Schwab. Some of y'all use Robinhood, doesn't charge commissions except for on just certain trades. Charles Schwab's, even on option trades, I used to pay $14, $15 for option trades. Now they charge me just pennies for an option trade. It's amazing. Commissions are free to a few pennies, where in the 70s commissions were $40, $50 per trade. So it's pretty amazing. And in fact, they were regulated. Not only were they $40, $50, but you had to charge that. You were not allowed to have a competitive commission. And so it's come down. That's commissions. So commissions are almost nothing now. So what you'll probably pay the most in as a small investor is the bid-ask spread. We will talk about the bid-ask spread later in the class when we talk about options. But if you look up a stock on Yahoo Finance, you'll see a bid price and an ask price. The ask price is the higher, and that's what you have to pay if you buy the stock. The bid price is the lower, and that's what you get if you sell the stock. It's really easy to remember. If you're buying something, obviously you have to pay the higher price. If you're selling something, obviously you receive the lower price. And that's what those market makers, that's what they make. They make the bid-ask spread. They make that. And the bid-ask spread is pretty important. It should just be a couple of pennies. You know, the bid might be $30.02, and the ask might be $30. So there's a $2 and a bid. So the ask might be $30.02. The bid might be $30. So you know it's a 2 cents difference. But I've seen some pretty wide bid-ask, even dollars. You know, $5 and $7 kind of thing. And if you see something like that, you should probably be very cautious. There's something unusual going on with that security, and you're probably going to have a really bad trade. Now that's small investors. Big investors, they're probably more concerned about market impact costs. Market impact costs is when you trade a very large block of stocks. So as a small investor, you don't have the issue. But let's say you trade 1 million shares of something. There's a good chance that trade is going to move the market. So you wanted to sell a stock for 50 bucks, but you trade 1 million shares, and before you can get that trade in, because your trade is so large, the price, you know, instead of buying it at $50, you have to buy it at $52 because you push the price up. That's called market impact. That is a huge cost to large investors. Same thing selling. You got to sell 1 million shares. As soon as you put the order in, the price drops because you've overwhelmed the supply and demand in the market, and you won't get the price that you wanted. Trade volume is critical. 1 million shares for one company might not be a big deal, but it might be a huge deal for another company. So you have to look at the trading volume. Large investors often hire transition managers. I used a transition manager a few times, and they try to reduce the market impact costs. I don't know if they really add value. They give you a report afterwards, and they say, "Wait, wow, we saved you all this money." But it's all statistical. They don't really know that they saved us money because they don't know what would have happened if it had been done a different way. But they statistically say, we think on average we probably saved you 5 basis points or 7 basis points. Who knows? But transition managers, they're trying to get you the best execution. That's a good term to know. Best execution. Get your best price on your trade possible by reducing market impact. And they can do it. Sometimes these big index funds like Vanguard and BlackRock, they're trading a million shares all the time. And so some of the things the transition manager would say is, hey, I've got someone trading 1 million shares, and you, BlackRock, you trade 1 million shares all the time. Can we just swap shares at the end of the day at closing price? I'll give you 1 million shares. Whatever the closing price is, you give them that price. That way you don't have any market impact. We don't have any market impact. Everybody's happy. Smaller fund managers like small cap funds, where this volume is very low, they may actually close their funds to new investors when they get to a certain dollar so that their market impact is not so large. So they're actually turning money away because they don't want a market impact. So we small investors, we have a huge advantage is we don't have to worry about market impact, whereas large investors do. Now, if you hire a manager, what expenses do you have? We've already talked about those expenses. We looked at it. Remember, we're looking at the Contra Fund from Fidelity. They charged 85 basis points. So that's the portfolio management fee. You may have heard the phrase AUM, assets under management. Some mutual funds charge front end and exit loads. I would never pay a front end or an exit load. You should be aware higher fees does not mean they do a better job. There are some awful, boy, I can name some companies that are terrible, terrible companies. I don't even know if they're still in business. They charge really high fees, and they have really horrible products. Even before fees, they have horrible products. But they do it with a really aggressive sales force that has high commissions, and boy, it's very unethical. So if you do passive, that's where you save the money. You just save a lot of money, and you're much more tax efficient because you don't have all these capital gains that you have to pay tax on. All right, so that's going to bring us to our next phrase. So we didn't really get into returns, but I recommend you read ahead. This will be a math question on the second exam, and we'll practice it and make sure you're ready for it. The math is not too difficult, and you'll have a few examples, and I'll work a couple of them in class so you can practice. But I do recommend, before you get into this class, this next video, go ahead and read Modified Dietz on Wikipedia and just see what I'm talking about there. All right, I'll stop it there.